Samsanyai. Exposed. The hidden 4200 AI tax loophole. IRS won't tell you. My accountant nearly fell off his chair when I showed him this. I'm sitting in his office last month, going through my quarterly numbers, and I pull out a spreadsheet showing $17,000 in AI tool subscriptions from last year. He looks at me like I've lost my mind. Then I show him how I categorize them. His exact words were, "I've been doing taxes for 23 years, and I've never seen anyone do this." By the end of that meeting, he found me $4,200 I was about to lose forever. Here's what most small business owners don't understand. The IRS has not updated their guidance on AI tools since ChatGPT launched. That gap between old tax code and new technology is where your money is hiding, and I'm going to show you exactly where to find it. But first, there's something happening right now that makes this urgent. The IRS is hiring 16,000 new agents this year. They're building new categorization systems. This window won't stay open forever. In the next 10 minutes, I'm going to break down the 4 specific deduction strategies my accountant validated, the exact language you need to use on your Schedule C, and the one mistake that triggers audits on AI expenses. That last one almost got me, and I'll tell you exactly how I caught it before filing. Let's start with the biggest opportunity most people miss entirely: the research and development credit. Now, before you click away, thinking that's only for billion-dollar tech companies, hear me out. The IRS defines qualified research expenses as costs incurred while developing or improving products, processes, techniques, formulas, or software. Read that again. Processes, techniques. If you're using Claude or ChatGPT to develop better sales scripts, that's improving a process. If you're using Midjourney to prototype product designs before manufacturing, that's developing a product. A bakery owner I know in Austin spent $1,800 last year on various AI tools. Sounds like a normal business expense, right? Her old accountant would have lumped it all under software subscriptions and moved on. Her new accountant looked closer. 700 of that went to an AI tool that helped her develop 3 new recipes by analyzing flavor compound combinations. That's product development. 400 went to an AI scheduling system she customized for her specific workflow. That's process improvement. Under the R&D credit, small businesses can claim up to $500,000 against payroll taxes. But here's what matters for most of us. Even sole proprietors can use Form 6765 to claim credits on their personal return. That bakery owner turned $1,100 in expenses into a $640 credit. Not a deduction. A credit. Dollar for dollar off her tax bill. Now, the R&D credit requires documentation, and I'm going to show you the exact system I use in a minute. But first, there's another category that's even easier to claim. Section 179 lets you deduct the full cost of certain business equipment in the year you buy it instead of depreciating it over time. Most people think this only applies to physical stuff like computers and machinery. Wrong. Software absolutely qualifies, and the IRS specifically includes off-the-shelf software that meets certain criteria. Here's where it gets interesting with AI tools. Many subscriptions technically give you a perpetual license to use the software during your subscription period. That's different from pure service fees. My accountant and I went through every AI tool I use and categorized them into 3 buckets. Bucket 1 is pure service. Think API calls where you're paying per use. These are straightforward business expenses on your Schedule C. Bucket 2 is software with service elements. Annual subscriptions to tools like Jasper or Copy AI, where you're licensing their software platform. These can qualify for Section 179. Bucket 3 is development tools. Anything you use to create, improve, or test business processes. R&D credit territory. When I recategorized my $17,000 in AI expenses using these three buckets, $8,400 moved from simple expense deductions into Section 179 and R&D credit categories. At my tax bracket, that shift alone saved me $2,100. And here's the part that surprised me most. The timing of when you pay matters enormously. I almost made a mistake in December that would have cost me over $800, and I'll explain exactly what that was. But this next strategy is the one my accountant said he's adding to his recommendations for every small business client. The home office deduction combined with AI tools creates a multiplier effect that almost nobody talks about. Stay with me because the math here gets good. If you use a dedicated space in your home for business, you can deduct a percentage of your home expenses based on square footage. Standard stuff. But here's the twist. The IRS allows you to include the cost of equipment and software used in that space as part of your home office deduction calculation, or you can deduct them separately as business expenses. Most people just pick one or the other without thinking. The strategy is to split them intentionally. Your AI tools that you use exclusively for business get deducted as business expenses. Your AI tools that are partially personal, maybe you use ChatGPT for work but also help your kid with homework, those get allocated proportionally under your home office percentage. I use 7 AI subscriptions regularly. 4 are purely business. 3 have some personal use. By splitting them correctly, I claimed full deductions on 4 and proportional deductions on 3, totaling more than if I just picked one method across the board. The difference was $480. Now here's the documentation system that makes all of this defensible if the IRS ever asks. I record all my AI work sessions using a tool called 11 Labs. When I'm using AI for business, the recordings with my voice notes prove exactly what I was working on. You can check it out at try11labs.io/2pu1009y92jl1. Having time-stamped records of your AI usage isn't just good practice, it's audit armor. My accountant called this the best documentation system he's seen for AI expenses because it creates an automatic log of business use. If you're finding value in this level of detail, hit subscribe. I break down one strategy like this every single day because the tax code changes constantly and most accountants aren't keeping up with AI-specific applications. Now, the mistake I mentioned earlier, the one that almost cost me $800. I paid for an annual subscription on December 28th. Seemed smart, right? Lock in the rate, get the deduction for this tax year. Wrong move. For Section 179 deductions, the software must be placed in service during the tax year. Placed in service doesn't mean purchased. It means actually used for business purposes. I bought that subscription December 28th, but didn't actually use the tool until January 3rd because I was traveling for the holidays. Technically, that expense should have been deducted the following year. My accountant caught it. We adjusted. But if I'd filed without checking, that $800 deduction could have been disallowed in an audit, plus penalties. The rule of thumb is make any AI purchases you want to deduct before December 15th and actually use them before December 31st. Log in. Run one business task. Document it. Now the final strategy that ties everything together. Bundling. Most AI platforms offer annual plans at a discount. But here's what smart business owners do. They pay for multiple annual subscriptions in the same tax year during a high-income year, then use those tools over the following 12 months. If you know you're going to have a high-income year, stack your AI purchases. Buy those annual subscriptions, even if you're already mid-year.